This is normally the time of the month where I go ahead and do my monthly real estate market update, but we're going to go in a little bit of a different direction this month, as you know, providing stats on average home price and sales and things like that is not quite as relevant. Hi, this is Andrew with the Andrew Smith team at eXp Realty, and it's not that long ago, just in the March report, we were talking about how strong the real estate market was and how fast we'd gotten off to start this year. And all of that and those projections are pretty much out the window at this point in time. If you saw the video and the update I did last week, it was fairly long. It had a lot of slides in it, and it talked about the coronavirus impact on the real estate market as a whole. Some of what I'm going to cover today summarizes that, but doesn't go into as much detail. I will put a link to that directly below, so if you do want some additional information, you can go back and watch that one. But the bottom line with what we're dealing with right now is nobody knows exactly where this is going and what's going to happen. We're in uncharted territory. It's unprecedented for a lot of us. So it's hard to get some accurate information. There's a lot of fear mongering. There's a lot of things being thrown around out there that I don't honestly know what they're based on. The facts behind it just don't add up. Now, I'm certainly not going to pretend to have all the answers for you, but what I can say, or I want to let you know, is that every Monday, Wednesday, and Friday morning, I participate in a group call that looks at the latest information from the economy, from housing, unemployment, all of the numbers, kind of assesses that. And there's a couple experts in there that kind of say, okay, here's what this means. So what I'm trying to do here is take that information I'm getting and then relay it out to you. So you've got the most up-to-date information that I have as well. Now, following last week's report that I did, in conversations with family, with friends, and some past clients, there were three main areas or three main questions that kept coming up in those conversations over and over. And the three areas that people were asking about was, when do you think the economy is going to recover? And what do we think that's going to look like? That was number one. Number two, is housing going to be like 2008? Are we going to kind of repeat ourselves? Is that what we're looking at? And number three was about unemployment, because obviously the unemployment numbers are unprecedented. So let's break that down a little bit here. So with regard to the economy, when are we going to recover? And the bottom line is we don't know for sure. What we do know is that the main investment banks are not looking for this to be a long, drawn-out process, assuming that the economy is able to reopen again in the somewhat near future. And I'm talking about the next 30 to 60 days. The reason for that, or the reason I say that, and the reason these leading investment banks are saying that, is the fundamentals of the economy, and especially of housing, were very strong going into what we're experiencing now. There wasn't any indication of a downturn. The stock market was doing great. Housing was off to a phenomenal start, as I said earlier. So the underlying conditions were strong. They were good. And what we've been hit for here is not an economic or a housing crisis. It's a health crisis that is then impacting the economy and housing. And the reason I bring that difference up is the expectation is that we'll snap back once we're able to restart things. How fast will we snap back? Most are projecting that although the hit to the economy is without a doubt going to be severe when the final numbers are reported for the first quarter and most likely the second as well, but we're going to see the bounce back in the third and the fourth quarter with very strong GDP, very strong economic growth. So it's going to be like a V-shaped recovery. And I did go into that quite a bit last week. It is almost as though what they're looking at now is the most recent time in history of something similar was when the bubble burst in the tech sector. So the dot-com crash. It was only the tech sector that was impacted, and also 9/11. Now, obviously, 9/11 was also an event, much shorter lived, but it was a shock to the system. And what they're looking at here is that this being the health crisis, is the economy is probably going to respond in a similar way. Now, when we look specifically at housing, is this like 2008? No, it's not. This is not a housing crisis. I was around in 2008. I was practicing real estate in 2008 and 2007 and 2006 and 2005 and 2004. Saw everything that led up to it and what was going on then. This is not the same at all. The underlying conditions in housing are drastically different. Back in '06, '07, '08, there was an oversupply. It was technically a buyer's market. Prices should not have been running away the way that they were. There was a frenzy that was being created. Lines at a builder releases a new phase. People were lined up. They were camping overnight. There was no reason for it. It was pure speculation. And a lot of it had to do with mortgage availability. Mortgage availability was a big key there. Now, when I say that, there is a graph known as the mortgage credit availability index. And what it basically says is the higher the number, the easier it is to get a loan. Now, in 2006, the mortgage credit availability index was at 868.7. Okay. If we look at where it is today, we're at 181.3. Now, exactly again, what those numbers mean doesn't quite matter, but as you can see, there's a big difference between 868.7 and 181.3. The point being is that the loans are not as easy to get. Now you actually have to qualify. You've got to have a job. You've got to have good credit. You've got to have a down payment, or you've got to have reserves. So it's a very different situation. The other important fact to point out here is back in 2007 and 8, people were using their homes as ATM machines. The number of cash out refis was through the roof, to the point where you could borrow, in many cases, up to 125% of your home's equity. The assumption was that prices would just keep going that way forever. And obviously that's not how it worked out. They didn't. In the 3 years, in 2005, 2006, and 2007, a total of $824 billion in home equity was cashed out. If we bring that forward to today, and we look at 2017, 18, and 19, $232 billion has been cashed out. Again, a huge difference in that. With that in mind, we have a big difference with regards to equity. And this ties in with where we'll go next with regards to unemployment. Back in '06, '07, '08, with the number of people that cashed out, when home prices dropped, because the housing and mortgage sector led the economy into the recession, when those home prices came down, everyone was stuck. There was no equity. People had used it all, and they'd used it to buy vacations and boats and clothes and stuff that depreciated, stuff that they couldn't unload and get money back out of. That's not the case now at all. 53.8% of all homes in the country today have at least 50% equity. 37% of that 53.8% are free and clear. Huge difference. The banks are much more prepared this time than they were last time. They're trying to get ahead of the curve. They're putting programs in place through the stimulus to help those that are truly in need. Truly in need. That's not to say that everyone should go out and apply for a mortgage forbearance. That will cause problems. If you have the ability to pay your mortgage, pay it. Okay? This is for people that truly need help. But if you have somebody that owns a home and they're really in desperate situation, can't pay their mortgage or there isn't help there, The vast majority of people are going to be able to put that house up for sale and sell it and get the equity out and move on. The number of homes that will actually get formally foreclosed on is not like it was back in 2008. People walked away. People here are not going to walk away from 40, 50, 60, 80, $100,000 in equity in their homes. Are still people still buying homes? Yes, they are. Homes are still selling. Sales numbers are down. I'm not going to lie, but they're still selling. My wife works for a home builder. They're still building. They're still selling. Their sales are down, but new contracts are still being written. People are still buying homes. And the inventory going into this was so much lower. There's still people out there that are going to want to buy homes. So the question naturally becomes, well, what about unemployment? If people aren't employed, they can't qualify for a mortgage and therefore they can't buy a home. Now, these numbers are likely to change, but as of this morning, the latest information from the U.S. Department of Labor Statistics shows that over 90% of the unemployment claims that have been filed are service sector related industries. Less than 10% of the claims are from manufacturing, white collar, management type positions. So we're talking airline industry, been hit hard. Travel industry, been hit very hard. Restaurants, bars, all of those type of things. Janitorial service in many cases. That list goes on. That could include your 17-year-old that works at McDonald's. They're not home buyers to begin with, so that's not going to be a direct impact. But the idea is, or the thought is, that as soon as the economy is allowed to reopen, that a lot of those jobs are going to flow right back. Are all of them? No, because it's unfortunate, but there's many small businesses that aren't going to survive this. There's restaurants that are going to go out of business. And it's going to be an adjustment for everyone. It's going to take a little bit of time for the economy to get cranked back up, but it will. In the area where I live in Texas now, even before this, there was a labor shortage. Someone opened a restaurant, they couldn't get help. A new hotel struggled to get employees. So that vacuum is going to get filled once we're able to move things forward and things get cranking around again. The part that's going to be interesting is how much will things return to the way they are, or the way they were, I should say. I personally think we're going to see a new normal. Travel could be impacted for a while, not vacations, but business travel. You look at it, businesses are seeing right now that they've been able to operate remotely. They've been able to do a lot more through video conferencing, Zoom, things like that. Are they going to need to continue to invest in expensive travel, or are they going to be able to do more remote things? What's that going to look like? And your guess is as good as mine. We don't know. But that, as of, again, it was tax day, so I'm recording this as of April 15th. So we will see. As I get continued updates over the next weeks, I will be letting you know what I'm hearing. But as of this morning, as of when I got off that call this morning, just over an hour ago, that is the expectation we are seeing right now. That is what the leading economic experts are saying. But again, only time will tell. In the meantime, if you have any questions, please reach out. Again, I don't have all the answers or pretend to, but any information I do have, I'm happy to share. So if there's a particular situation that you want more information on, again, reach out. You can send me an email, you can give me a call, and I'd be happy to talk that through with you. In the meantime, keep washing those hands. Try and not go crazy in quarantine, and stay safe. Or as I had a friend tell me the other night, he placed a bottle of alcohol in every room in his house so that he could go bar hopping. So whatever it takes to get through this, right? So all of you take care, and we'll see you soon.